My name is Chinedu Onoha. I'm a forex trader. I'm also a forex coach. I've been trading for about 10 years and I've been in the coaching business for approximately 4 years. And I'm presenting to you today the high probability forex trading strategy with almost 100% accuracy. Now, don't get me wrong, this strategy would not win all of the time, but it sure will win most of the time. And I'm going to share with you precise entry and exit points with precision. All right, so when we talk about high probability trading, what we are looking at basically is the confluence of factors. Now, I'm going to be sharing with you three confluence of factors. In my previous videos that talked about divergence, I mentioned a few things and I'm going to improve on some of those things that I talked about earlier. All right, so I want you to listen attentively so that you would be able to get exactly what I'm about to share with you today, because I'm sure this would help someone to make consistent profit. All right, I'm going to introduce divergence again for some of you who have not listened to my previous videos. And divergence, I'm going to focus on hidden divergence. Now, there are two major types of divergence. The first type is the regular or classic divergence. Now, every oscillator, this is an oscillator, by the way, this is the HP oscillator, which I would basically be using for this teaching. Every oscillator is a slave to price. In other words, price can a oscillator cannot move if price does not move, which means oscillator is a slave to price. In other words, the oscillator is lagging. However, if price is making a lower low, the oscillator is expected to be doing the same thing. If price is making a lower high, the oscillator is expected to be doing the same thing. But whenever there is a disagreement between the oscillator and price, then we have divergence. So look at this. Price is making a lower low and the oscillator is making a higher low. Look at the corresponding low here. Price is making a lower low. The oscillator is making a higher low. All right. So this is regular divergence. This is bullish regular divergence. Now, what we are concerned about is not regular divergence. What we are concerned about is hidden divergence. Let me show you bearish regular divergence. Notice that price, this is a short one, price is making a higher high. It is expected that the corresponding part of the oscillator should also make a higher high. But you see, price is making a higher high, the oscillator is making a lower high, warning you of a possible push downwards. Now, this is not what we are interested in. We are interested in hidden divergence. Now, what is hidden divergence? It is a trend continuation divergence. Remember, we are always told to trade in the direction of the trend because the trend is your friend. So when price is making a lower high, it is expected that the oscillator should also be making a lower high. But look at this case, price is making a lower high. This is a high lower than this previous high. The corresponding oscillator is making a higher high. Now, this is a warning that price is most likely headed downwards. All right, so let's look at the bullish example. If price is making a higher low, the oscillator should also be making a higher low. Now, anytime there is a disagreement, then that is hidden divergence, possible trend continuation. All right, look at price here making a higher low. This is a low higher than this previous low, but this oscillator is making a lower low. Okay, warning you that price is most likely headed up. Now, what I'm saying here is that price and oscillator, whenever they disagree, you have divergence. Now, hidden divergence on its own is a high probability trading strategy. However, you cannot just trade with hidden divergence alone. You need a confluence of factors. And I'm going to share with you three major confluence of factors. The first one, for me to take a buy order, I need to have the hidden divergence seen. So hidden divergence shown, price making a higher low, oscillator making a lower low. That is number one. Number two, I need this pullback to happen to a recent support level. I prefer this kind of movement. 1, 2, 3. 1, 2, 3. A resistance broken, retested. Now you see the confluence. Price is sitting right at this recent support level, a resistance level turned a support level. Now that is confirmation number two. Now the last confirmation is that I want the hidden divergence to the oscillator to be in the oversold region before I can pull the trigger. Now let me run through this again. Entry number one, hidden divergence must be seen. Number two, price must be sitting at a support level for a buy. And then the last confluence is that the oscillator has to be in the oversold region. At the close of this candle, you pick your buy position. How simple can that get? Now, for traders who do not know how to spot hidden divergence, I have created a tool that would spot it for you using this very important tool. Now, one of the reasons why I love this tool is simple. It is a lot more efficient than the regular stochastics. It is a lot more efficient. It's smoother. You would see it a lot more filtered. Okay, I've painstakingly done that. Now, you would also see let's use this example on AUDCHF. This is the oscillator that automatically draws hidden divergence for you. So you would be able to spot hidden divergence with the help of this oscillator without you really having to do anything basically. All right, so let's look at that same setup to see how this represented it. All right, here we are. Okay, look at this place. Look at this place. Hidden divergence. The hidden divergence oscillator has already drawn it, shown you hidden divergence, that price is making a higher low and the oscillator is making a lower low, and therefore price is sitting here. So this is a trigger. So this only helps you to spot hidden divergence if you're having difficulties finding hidden divergence. Okay, so whenever you see this setup, you place your buy order. Now, how do you exit? Because it's important that we have defined entry and also defined exit. Now, at the close of this candle, this is the trigger candle. The beginning of this candle is the trigger candle. Your exit should be the distance from here to this swing is 131 pips. So let's say an average approximately 130 pips. What we now want to do is project 130 pips from the point of taking the trade. So the point of taking this trade, we want to project 130 pips. That's our target. Now the stop loss, I recommend half of this, and half of this would be 65 pips. So your stop loss needs to be somewhere here. Let's look for a sell example. Let's look for a sell example. We're going to GBP AUD. The sell example, price has to be making, okay, here we are. Okay, first of all, there has to be hidden divergence. Hidden divergence, price is making a lower high and the oscillator is making a higher high. Now you can see clearly that the hidden divergence, the HP oscillator for hidden divergence has clearly drawn hidden divergence. Again, price needs to be seated around a previous resistance level. So see this pullback, apart from hidden divergence, see the pullback going back into this level, and at the close of the candle that moved the oscillator into the overbought region. As long as you find these three factors, your trigger candle is here. Now let me run through this again. First of all, confluence number one is there has to be hidden divergence. Price is making a lower high and the oscillator is making a higher high. That is number one. Number two is that pullback has to be at a recent, in fact, remember I said 1, 2, 3. I prefer it this way. It has the highest probability. You want to have the most recent swing 1, 2, 3. So price is reacting at this level, and then you have the hidden divergence, and you have the oscillator while it is showing hidden divergence in the overbought region. And I use 90. Note this, 90, and you can simply set this by going to this place and adding the level. So simply click here to set or add if you want to add a new level. Okay, but now we don't need this level. All right, so I'll run through this again. Hidden divergence, price making a lower high, oscillator making a higher high, sitting right at a resistance level at an overbought. Whenever the candle closes overbought, that is your trigger candle. Again, the exit point is price, the distance from the highest to the lowest. This is 200 pips. Now 200 pips is your projection, approximately 200 pips. So your stop loss should be half of that. So you should be targeting a stop loss of about 100 pips. This increases the odds in your favor. Like I said, this strategy will not be winning all of the time, but most of the time you would be making consistent profit. Now, good news is you can trade it on all currency pairs, on all instruments, on all time frames. And however, I recommend the 4-hour time frame. So I'm sure you would have fun with this tool. And if you would have any questions, you can always contact me. My details are below this video. And if you are looking for a place to download the HP oscillator, you would find it right below this video. So thank you so much for listening, and I hope this helps someone. Have a lovely day. Bye for now.